Hi, I'm Chris Wright, President of Wright Wealth Management Group, and today we're going to continue our conversation on annuities. On our previous podcast, we discussed the idea of immediate annuities or income-only annuities. We also discussed fixed annuities. Today we're going to discuss two additional types of annuities. The first will be what is considered a fixed indexed annuity. Some refer to this as a hybrid annuity. And the final annuity we will review is a variable annuity that uses mutual fund subaccounts as its investment vehicle. There's a lot of hype surrounding indexed annuities currently. A lot of financial representatives and insurance agents throughout the nation are advertising this concept of an indexed annuity that can actually have maybe the potential to participate in market-linked returns without having any downside risk based upon the claims paying ability of the insurance company. These types of annuities will often use an index such as the S&P 500 as the crediting method to help determine how much interest earnings the annuity can participate in. So for instance, if an investor had an indexed annuity that they were participating in, and that indexed annuity had a 50% annual point-to-point participation rate of 50%, if the S&P 500 went up 10% during that 12-month period of time, the investor would receive a gain of 5% for that 12-month period. On the other hand, if the S&P 500 was down negative 20% in a 12-month period of time, the investor would not lose any money because the indexed annuity only participates on the upside and not the downside of the S&P 500. These have become very attractive for some investors who want to have some type of participation in the markets, but have some type of guarantee that is based upon the ability of the insurance company that is offering the annuity. Does this make sense for investors? It may for some, it may not for others. There's a lot of information surrounding annuities and whether they have the right fit or not in someone's portfolio. One of the nice benefits of a indexed annuity is the annual reset feature that is built into the annuity program. I'll explain what an annual reset feature does and how it can really benefit an investor over time. Let's say that the S&P 500 index was at 2,000 points. And at the end of the 12-month period, let's say the first year the investor had placed their money in that indexed annuity, the S&P actually had dropped from 2,000 points to 1,800 points. Well, we know with an indexed annuity that investor would not lose any money because of the 0% floor and the non-participation when the market is down. But an additional benefit is when the market is down, with an annual reset feature, the investor's money and starting point for the next 12 months would be based upon that 1,800 point level of the S&P. So if the S&P then went from 1,800 up to 1,980 points, which would be a 10% increase, even though that 1,980 points is still less than the original 2,000 points, the annual reset allows for a gain in that year of 10%, and with the investor having a 50% participation rate, the investor would then receive a 5% gain, even if they were still below that original price of the S&P or value of the S&P of 2,000. That's a nice feature of the annual reset. That really doesn't happen with stocks or mutual funds. If you buy a stock at $100 a share and it falls by 20% and now you have $80 a share, you're really not earning money if there's no dividends associated with that stock until after that stock is back above $100 a share. So the annual reset feature of the indexed annuities can be very powerful in a market or a period of time that is very volatile and choppy, where there's lots of ups and downs from year to year. The reset feature allows the investor to buy back in, if you will, or reset with the new value of the index and then ride it up potentially from there and receive an index credit based on their participation rate.